In this video, we'll be talking about general mortgage knowledge, programs, and terminology. First, we will be covering some general items. Calculating loan-to-value. To calculate loan-to-value, you would take purchase price or appraised value, whichever is less, divided into the loan amount. To calculate combined loan-to-value, you take the first mortgage plus the amount drawn from the HELOC divided by the value. To calculate total loan-to-value, you would take the first mortgage plus the total of the HELOC or second mortgage divided by the value. Terms. Table funding. Funding of the loan at settlement, simultaneously transferring the loan to the lender. Mortgage banker. A company that can underwrite or fund loans. A mortgage broker does not fund or underwrite loans. Yield spread premium, commission paid from the wholesaler to the broker in exchange for selling a borrower on a higher rate. The higher rate often alleviates the borrower from paying an origination fee. Extended lock agreement. If issued, it protects the borrower from rising rates during the lock period. Must contain loan program, interest rate, cost, and expiration date and be between the borrower and the lender. Delinquent loan. Any loan over 30 days past due. Discount point. 1% of the loan amount can be paid upfront and in addition to other origination fees to reduce the interest rate. Premium pricing. Utilized in helping the borrower pay their closing costs. The premium results from the interest rate being increased. Cash out refinance. Borrowing equity from the value of the home, thus increasing the loan amount owed against the home. Rate and term refinance. An extension of the term or reduction of the interest rate to reduce the amount owed in the monthly payment. Right of rescission, the option given to a borrower to cancel a HELOC or refinance. The borrower must act on this right within 3 days of the closing. Junior liens, a second mortgage or HELOC. Escrow accounts, accounts that are paid into by the borrower for taxes, insurances, and possibly HOA or POA fees. The money is the borrower's and not the mortgage company's. Repurchase. An investor requiring the originating lender to buy a loan back because of fraud, unacceptable underwriting, or appraisal. Liens. Secures the repayment of a debt owed. Examples include first mortgage, second mortgage, IRS tax lien, judgments, and mechanics lien. Early payment default. A new borrower does not make the first, second, or even possibly the third payment. Fraud may be the cause. PITI. Principal, interest, taxes, and insurances. Gift funds. Gift funds are sometimes used as part of a borrower's down payment. They are most often gifted from a relative and cannot be conditional of repayment. Temporary buy-down, usually a 2-to-1 buy-down. The payment rate is 2% less the first year, 1% less the second year, requiring a buy-down account held by the lender for the difference between the note rate and payment rate. The borrower must be approved at the note rate. Accrued interest. When you make your monthly payment, the interest paid is for the month before. Conveyance. Transfer of ownership, usually through a deed. Secondary market. Sale of closed loans to investors or Fannie Mae or Freddie Mac. Assumable loan, allowing the buyer of a home to take over the existing mortgage. Fannie Mae and Freddie Mac do not allow assumptions. FHA and VA will if the new buyer is approved by the lender. General mortgage knowledge, programs, and terminology. Conventional conforming. Any loan that can be sold to Fannie Mae or Freddie Mac. Terms of a conventional conforming loan are: maximum LTV is 97%. Any loan above 80% must have mortgage insurance and escrows. Payment to income ratios, 28% for housing and 36% overall, also known as the front and back end ratios. No repayment term over 30 years. No prepayment penalties or assumptions. Non-owner occupied is allowed. Non-conforming and non-traditional. Non-conforming. Any loan that cannot be sold to Fannie Mae or Freddie Mac. Some examples are jumbo mortgages or any other loan using non-verifiable income. Non-traditional. Any loan that is not a 30-year fixed. Government-backed loan programs. FHA, Federal Housing Administration, maximum LTV is 96.5%, 31% for housing, and 43% overall underwriting ratios. MIP is required for the life of the loan if over 90% LTV. Seller concessions are limited to 6%. All borrowers must be run through CAVERS. It will tell the lender if the borrower has an open FHA loan, default on an FHA mortgage, or government-insured student loan. The borrower may not be eligible for another FHA loan. The borrower must live in the home for at least 60 days. Upfront MIP is 1.75%, which may be added into the loan. The MIP renewal is 0.85 of the loan amount divided by 12. Monthly MIP premium is to be added to the P&I payment. USDA, United States Department of Agriculture, available for areas of less than 35,000 people. 100% financing. Income limitations are set for eligibility. 29% front-end and 41% back-end underwriting ratios. MIP, government mortgage insurance is required for the life of the loan. USDA must underwrite and fund all USDA loans. VA loans, Veterans Administration. The down payment on a VA loan is determined by obtaining the DD-214 from the veteran. This information is entered into a VA website to generate a certificate of entitlement or eligibility. Once the COE is issued, the amount of entitlement benefits that may be utilized by the veteran may be calculated. Maximum loan to value is 100%. The maximum guarantee authorized by the VA is 25% of the loan amount, up to $113,275. The maximum VA home loan limit is the same as the current Fannie Mae or Freddie Mac loan limits. Overall underwriting ratio is 41%. Residual income is also utilized in VA loans. Adjustable rate mortgages. There are 5 parts to an ARM. For example purposes, numbers are provided with the explanation. Part 1. Program. For example, a 5-1 ARM means that the rate is fixed for 5 years and then adjusts every year thereafter. Part 2. Caps. The limits the interest rate can adjust with each adjustment and over the life of the loan. For example, a 2-5 ARM. 2% is the limit the interest rate can go up on each adjustment. 5% is the lifetime cap. The lifetime cap is added to the starting rate, which is the highest the rate can go over the life of the loan. If the starting rate was 4% and the lifetime cap is 5%, the highest the rate can go over the life of the loan is 9%. Part 3. Margin. The only number on an ARM loan that cannot change. It is also the floor, meaning the interest rate cannot go below the margin. Part 4. Index. The most common index is based off of LIBOR, which stands for the London Interbank Offered Rate. The rate changes throughout the day. Part 5. Fully indexed rate, adding both the index and the margin. The borrower is underwritten at the higher of the starting interest rate or the fully indexed rate for qualification purposes. Reverse mortgages. There are 5 components to reverse mortgage. They include 1. Negative amortization. Payments are made to the borrower from the lender, drawing equity from the borrower's home. Each month, their mortgage balance increases as the interest is not paid. No mortgage payments are required until after the borrower's vacancy of the home. 2. Escrows are not included in the payment. The borrower is responsible to pay their own taxes and insurance. 3. Minimum age to apply, 62 years old. 4. Mandatory counseling must be provided prior to the borrower applying. 5. Non-recourse mortgage. If the mortgage balance is higher than the value at the end of the loan, FHA absorbs the loss. Additional items. 3 requirements the borrowers have to fulfill to maintain a reverse mortgage. The borrower could lose their home if they don't do the following. 1. The property has to be their primary residence. 2. They must maintain the property. 3. Taxes and insurance have to be paid by the borrower. Factors in determining the amount of the mortgage and monthly payouts to the borrower include age of the borrower, loan to value, and the interest rate. Second liens. Purchase money second. A PM2 is a second mortgage that closes with a corresponding first mortgage from the same lender. These loans are often used when the borrower only has less than a 20% down payment and would like to avoid having to pay PMI. For example, you may see a borrower with a 10% down payment who takes out simultaneous second mortgage for the remaining 10% and a first mortgage for 80%. HELOC, home equity line of credit. HELOC terms are generally between 5 to 15 years, with some available up to 25 years. Floating interest rate is generally based on prime rate. No principal monthly payment is required, however the borrower may choose to pay it. The entire loan balance will be due at the end of the loan term. Borrower does not pay interest on the loan unless they draw part of the proceeds. Then, each month, they will pay interest on the balance they have drawn. Example, the value of a property is $200,000. The amount owed on the first mortgage is $100,000. The HELOC lender can lend up to 80% LTV. The HELOC amount could be up to $60,000. Second mortgage. All of the proceeds are paid out at closing, with the borrower needing to start making monthly P&I payments, usually within 45 days after closing. The term is 15 years and can be either an ARM or fixed rate mortgage. Subordination agreement. A subordination agreement needs to be recorded stating the position of each mortgage and their priority of repayment. If the borrower wants to refinance the first mortgage, they have to obtain a signed subordination agreement from the second mortgage lender, which says the second mortgage lender will stay in second position while the first is refinanced. Construction loans. There are two types of construction programs. Construction loan with a permanent takeout. The consumer obtains a construction loan from a lender. The construction lender will request a permanent takeout before making the construction loan. A new company or lender will take an application and process the information as a new loan. If approved, a commitment letter will be issued to the borrower. When the construction is completed, if the borrower meets the requirements of the commitment letter, the new lender will pay off the construction loan and the borrower will begin making payments on the permanent loan. Second type of construction program, construction perm. The consumer will close on a construction permanent loan with one set of closing costs. Borrower has the home built and will pay interest on the draws to pay the contractor as bills are presented. Once the construction is completed and a final inspection is issued, the lender will calculate the P&I payment based on the amount of the loan and the remaining term of the loan. Example, if it took 10 months to build the home, the new payment would be calculated on the remaining term of 350 months. 360 payments minus 10 equals 350 months remaining. Interest only. Interest is required to be paid every month. The principal payment is not required but may be made if the borrower would like to pay the loan amount down. The balance of the loan will be the same as the original loan amount even after 10 years, if principal payments were never made. The borrower is qualified at the full P&I payment plus escrows. If they qualify, they will be allowed to do an interest-only loan.